Welcome to the Critical Minerals Roundtable.
So without further ado, I'm going to cover the companies you're going to be hearing from. In the diversified critical minerals space, we have Terry Lynch, CEO of Polymetallic Mines, one of the world's most promising polymetallic discoveries. Mark Bishop LaFleche, CEO of Ecora Resources, the critical minerals royalty company. We also have Corey Diaz, CEO of Anfield Energy. Anfield is restarting one of only 3 permitted uranium mills in the U.S., and then we're going to hear from Rob Weir, head of corporate development at Lithium Royalty Corp, which is the lithium-focused royalty company. And to round things off, we're talking copper with Christian Easterday, CEO of emerging developer Hot Chili, and Aurora Davidson, she's CEO of Amerigo Resources, which is a dividend yield-focused producer.
This Critical Minerals Roundtable is divided into 3 key parts. First is demand outlook. Second is supply and capital deployment. And third is company-specific catalysts. Scott will provide an overview of the first segment, demand outlook.
So on the demand outlook front, we're looking at reshoring and security of supply as a catalyst for critical minerals, uranium and lithium pricing environment, copper's resilience versus oil's weakness, critical minerals demand outlook, and AI, a new vector of demand.
Disrupting optimized commodity flows globally. So in other words, supply chains that have been developed to minimize friction costs to deliver commodities globally, ultimately in part delivering low commodity prices, is impacted. So to put it in other words, disrupting global supply chains is inflationary. At least we've seen it already as a consequence to commodity flows following the Ukrainian and Russian conflict, and in met coal and energy prices more generally. And I think that really applies to a lot of the commodities that Ecora has exposure to as well in our critical minerals focus. So for a royalty company, inflationary pressures in some ways are good and positive. And in the longer term, I think that these types of reorganizations of trade flows is inflationary to commodity prices, and Ecora is very well positioned to benefit.
You know, I gave a speech at the Critical Mineral Forum just a couple of weeks ago called Fortress America. So I really think that, America's definitely changed its perspective on trade, and it's, they've definitely decided to go with something that's more not price driven, but more resilient, more supply chain driven. So that's why I think, for North American critical minerals, it's particularly bullish. And I think if you're inside the envelope, which I think Canada and Mexico will be part of that framework, then you're going to be in a preferred position to be a supplier to the U.S. industrial base and military complex as well. And the Americans are increasingly going to, invest, whether through supply offtakes at above market prices, in places like lithium. I was surprised. I was at a conference in Washington, D.C. about maybe 6 weeks ago, where that topic came up, and I believe these deals will happen. So it's going to be a different landscape, and it'd be very bullish for the domestic suppliers of critical minerals.
Well, that's a complex question. I think that we are seeing more global competition for strategic commodities, no question about that, including copper. Certain commodities are evolving to become chess pieces in power plays that are important to ensure supply chain and infrastructure resilience. There's talk about securing technological leadership and defense security. In the case of copper, what's really interesting to consider is that needing more copper does not mean you will have access to that copper. The fundamental copper story of growing demand and constrained supply is well known. We've talked about it a lot. However, in my view, it's not even sufficient for countries to strategize about copper supply in terms of securing mined copper. The question of who mines copper and where is only part of the picture. There are other very important questions, such as the fact that Western countries have almost no offtake agreements. So in other words, long-term supply agreements are already in place for around 80% of the world's mined copper supply, and that copper is going to the smelters in China. So China, Japan, South Korea are getting that copper, but that copper is not going to reach the US or Europe. So going forward, what we may see is a different approach where countries are required to build new alliances and set up very strategic offtake agreements that secure copper supply regardless of market prices. So this could be a potential catalyst between traditional supply and demand economics, and companies that produce copper in stable jurisdictions can do very well in such a scenario, Scott.
I do. I think, I think especially within the U.S., I think the U.S. in some ways, in the past, had kind of abdicated its opportunity when it came to nuclear, and allowed, other foreign actors to step into the breach and, provide, whether it's expertise or construction of nuclear facilities worldwide. And I think that, the U.S. has always been, one of the leaders when it comes to manufacturing, innovation, worldwide. So I think now it's a game of catch up, and I think that there's a real commitment from the administration to become a leader once again, in another sector, and this time nuclear. So I think from our perspective, I think it's a great opportunity, knowing that not only do they want to create the final nuclear reactor, but they also want to have the feed within country in order to support those new nuclear reactors and existing reactors. So I think from that perspective, I think it's a great opportunity for those who are domiciled in the U.S. who can provide that domestic supply and limit external forces from participating or trying to leverage that participation into some other choke point when it comes to the needs of the nuclear reactor fleet in the U.S. So I think we're in a great position. There's going to be a bifurcation of pricing in the uranium market. I think there'll be a U.S. price, and then there'll be a non-U.S. price. I think with tariffs, I think with other means of trying to restrict external supply to the U.S., I think that's going to make the pounds that are within country that much more valuable. And so I think that a lot of the reactors will look to acquire pounds that they can see and visit. Because they're going to feel comfortable knowing that the supply chain won't break down because it's in the country. So I think there's a lot of risk, and uranium's always been a story of geopolitical risk. And so I don't think that that's going to change, but I certainly think that U.S. suppliers will kind of get a better understanding that having domestic supply makes the most sense because there's low risk.
Yeah, sure. It's been terrible. To put a word to it, you've basically had, we're in the fourth cycle the last 10 years. We've had two 24-month up cycles. We've had one 35-month down cycle, and this current bear market is approaching month 31. So it's been pretty. I think the spodumene price bottom last cycle at 350. Today we're around 600. And you've just had some. I think I don't want to call them marginal, but you've had assets in higher risk jurisdictions come into production, generally very low grade. I think they're having a hard time right now. So prices have been challenging. They're way below incentive for Western countries to build projects. But the growth in the lithium market last year was greater than the entire market was in 2018. So it's still a smaller nascent market, but it's got a massive compounded growth rate. And the surplus today is probably not as much as the consensus believes. So we're, one asset going into care and maintenance away from being back into a directionally stronger price environment. So it's been ugly, but I think things are going to get better here over the course of the next 18 months.
Yeah, it's interesting. If it's sort of a bit of the old versus the new, right? So copper is, of course, been used traditionally, in electrification and urbanization. Those are the 90% of the copper demand. But the burgeoning greening economy, both in terms of EVs and also AI, is meaning much more copper is needed because you need much more electricity. So that's sort of driving the demand for that. And of course, the other thing people got to reflect on within supply demand equations is what is is there a buffer zone? Can we can we readily turn on marginal supply? So you can't readily turn on copper supply. It's very inelastic. So it takes a long time to get these things in production. And once they're in production, and once they come off production, they're done. So they have to be replaced by new deposits. Whereas oil has got quite a buffer, right? Because of OPEC, There's a lot more supply than there is demand. Not a lot, but at least a buffer. So on that case, it's like the price is less inelastic. So I think copper generally the market has perceived that. I think copper is up overall about 25% year over year, whereas oil sort of down. I think that the world just perceives that copper is relatively going to perform well, even in a tariff slower economy than oil. So I think those are the factors, and I suspect those are accurate observations.
Yeah, and look, again, it's got another data point in history with this growing trend of copper originally being seen as the economic bellwether indicator, Dr. Copper, as some people call it. That relationship has been changing. It's been changing for quite some time, and it's continuing to decouple from that historical relationship with oil prices. What we're actually looking at the moment is a physical market that is really dictating that higher sticky price for the metal. So with almost a 6 million ton deficit in concentrate supply to refineries and negative treatment charges and refining charges, that market is going to be tight for a long time to come, and is responsible for those higher metal prices.
I think historically copper has been highly correlated to GDP. Obviously, everyone knows this. But I think copper and demand sources for copper are really diverging from where they've been over the last 20 years. Copper over the last, or in, say, the first part of this century, a large part of the copper demand growth story was China driven. And I think when you look at the next 20 years, it's electrification, right? I mean, of course, GDP growth is important, but certain aspects of copper demand growth, like electrification, like data center demand or digital infrastructure, inclusive of, battery consumption, grid investment, some of these are somewhat less sensitive to cyclical pressures that you might see as a more general GDP trend. And the one part, of course, of copper demand is armaments. I mean, the reality is armaments are incredibly copper intensive as well, and represent a fairly sizable portion of global copper demand that in the coming years is expected to grow substantially. So I think you do have obviously the classical copper will follow GDP growth, but I personally wouldn't be surprised if you saw a slight reduction in the correlation given some of the other areas and some of the more emerging end markets for copper that can be less sensitive to more general GDP. And then for lithium, look, I think lithium is a story that when you look at lithium outlook on prices, is really sensitive to EV demand growth. I mean, if you fluctuate EV demand growth up or down by 1%, and compound that over 5 years, the price outlook or your expectation around lithium prices is very different. The reality is the trend is again very positive, but we're also seeing in the world today an intention to add new supply, and a lot of that new supply is at the low end of the cost curve. So I think at Ecora we're constructive on lithium. I think we think the key is to get the right entry points and to have exposures that are at the low end of the cost curve and operations that can effectively generate free cash flow throughout commodity price cycles. And that's what we would do on any royalty, lithium or any other critical mineral that we consider.
So EV and battery storage are the two very obvious ones. I think this year EV is going to grow 30%, which will be the first year-over-year increase in 5 years. You tell me what battery storage is growing at. It's somewhere between 50 and 100%. I think really conservatively, if you assume 10% compounded annual growth for EV, 20 for ESS, and that gets you to 2 million tons of demand. And then AI was sort of a crazy concept 10 years ago, and all of a sudden that wave has hit the beach. Humanoid robots and these electric vertical takeoff landing vehicles. There was a $1 billion order out of Saudi Arabia this week. So if you look in the CATL prospectus, they are 60% above consensus for 2030. And so they talk specifically about other applications outside EV and ESS. So it's I think that's a great document, or even that page just on their demand drivers to really forecast out the next decade and a half.
Yeah, well, I mean, critical minerals is a broad subset of minerals, and I think if you look at the if you look at the picture, I think it looks good for all critical minerals as you look out in the horizon. I think it's very difficult to isolate a single critical mineral and say, the supply demand fundamentals over the long term are anything but very positive. I think one of the trends that we see in critical minerals, and it's happened actually in, say, lithium, nickel, cobalt, but in particular, focus in on lithium. What you have is a really fast growing market and very choppy supply additions. And the consequence is price volatility. So the demand trend is very positive, but the supply demand balance can move around equilibrium. Cobalt is another example. Demand last year is estimated to have grown in the teens, the mid-teens by the Cobalt Institute. But supply last year was such that you don't really see the impact of that demand growth. So I think directionally the demand trend is positive across the suite. We at Ecora really like copper in particular, and it's why we've gone out and put copper at the center of our commodity exposure. But we've included around that a number of critical minerals like nickel, like cobalt, like uranium, like vanadium, rare earths as well. And we're keen to round out that exposure while remaining a core of around copper.
Thanks, Scott. I think outside of traditional demand, which actually can't be underestimated, the traditional sources of demand in infrastructure spending, etc., I think is going to continue and probably continue to see good CAGR growth over that part of traditional demand. More recently, we've been hearing about the impacts of obviously the growing need for copper in the electric vehicle market and hybrid vehicle markets as the world starts to transition to a higher component of electric vehicles. And more recently, we've been discussing the impact of AI and some wild differences in how much copper will be required for that growing segment of demand. And if you want to listen to the developments going on in humanoid robots, that appears to be the next horizon of growth. So all very positive for new areas of demand that are copper intensive, that will be certainly changing things in the next 10 to 15 years. Segments that were 3% growing to 8% and 10% of overall demand. And what you actually want to look at is a pie graph of the actual total physical demand breakup in the next 10 to 15 years. That's what's going to be more important to watch. What is the size of this market going to grow to over the next 10 to 15 years? We've been hearing about a market that could get to 50 million tonne of demand by 2050 to 32 million tonnes, 31 million tonnes of demand by 2030, which is only 5 years away. So, certainly we're seeing no end in new demand areas opening up for copper because of its amazing electrical qualities and conductivity qualities that are almost unrivaled for substitution to be much of an argument to discuss around aluminium cannibalizing parts of the demand demography at the moment. So, no, I think it's going to look very healthy and all of those areas of new demand. There are going to be a lot of eyes on that area of uptake for the world.
The copper demand story has been very consistent. You can look at 50 years of copper consumption data, and you can see that global demand has grown 3 to 4 million tons per decade. This growth has been consistent regardless of economic downturns. Now, the world population has doubled since the 1980s. We now have more than 8 billion people today. This means that copper remains indispensable in developed nations, but here's the question, more important in emerging economies. About 1 billion people have no access to primary electricity, and another 2 billion have only intermittent or unaffordable access. So this is a vast, unavoidable source of copper demand. This is what's being called the copper needed for human development. The higher the rate of development of a country, the higher the installed copper capacity is per person, per capita. And there are numerous low income and middle income countries that are significantly behind in this installed capacity. A recent study I read said that in order to get to the levels of installed capacity the US has, these countries are going to be needing more than 1,000 tons of copper by the year 2100. So this is about 50 years of current annual copper production just on that closing of the gap regarding basic electrification. I'm not talking here about energy transition, just living as usual numbers, and they are quite sobering. So that's a way of seeing where a significant source of demand for copper is going to be coming from.
Impact AI is going to have on everything is underappreciated. So I think some of the numbers on AI energy needs are absolutely ridiculous. But I can see it. You can just see in every day how it's impacting everyone's lives. How this is going to basically mushroom. And so I think that's probably underappreciated, even though it's obviously hyped up a lot. Now we've got this extra demand, that's sort of been unforecast. The AI is sort of a new one. So it's the supply demand thing for copper looks ridiculously bullish. This year is probably almost sort of evenly balanced. A small, depending on who you talk to, it's a small, excess supply or a small excess demand, but very, sort of on the sort of even. But if you look out to 2030, 2035, we could see like a 30% supply deficit. What will that do? Well, I mean, it's obviously going to drive copper pricing and drive copper investment. So I think the bull case for copper is pretty strong.
Yeah, look, I think there are nice kind of ancillary opportunities, right? But I think if you look at the supply-demand imbalance, excluding AI, excluding these other opportunities, I think it's pretty clear that there's a massive supply-demand imbalance, and this is just going to put it further out of balance. So I think those pounds, any pounds that are available, to service not only nuclear reactors but any of these other ancillary businesses, I think are those pounds are going to be much more valuable going forward. So I think that it's always nice to have these other opportunities, within AI or other newer technologies, newer innovations. But I think the fundamental supply-demand imbalance is so great that these other things you're just piling on. The difference between the supply available and the demand required. So from our perspective, any other addition just provides, I guess, more of an urgency to how quickly pounds need to be produced within the U.S. and having that access to that material as a player in the sector, I think it makes our pounds that much more valuable every time we hear about a new innovation, a requirement for energy.
Our next topic is supply and capital deployment. In this category, we'll cover supply dynamics for each of the critical minerals, funding environment for projects, and U.S. executive orders to support critical minerals production.
No, Scott, is the short answer. Not by a long way. We seem to be standing on the tracks in front of a slow-moving train crash, and we're not getting out of the way. There needs to be a significant lift up in exploration commitment and expenditure for the global sector. New mines are not being discovered. Not many large new discoveries are coming into the pipeline. That trend is continuing, and I imagine we'll have a significant bite on the price at a particular point. But at this stage, no, we're not seeing that incentive for large exploration budgets to be deployed to the copper sector.
No, it's not doing A or B. Major mining companies have underinvested in exploration and in development for years. Exploration budgets peaked in 2011, and we've never gone back to those levels. New copper mines take decades to achieve commercial production because of the risks of advancing from discovery to production. So the incentive to pursue these investments has not materialized. And as a result, we have a very thin pipeline of additional demand coming in.
It seems like we're going to definitely be undersupply in copper for sure, most likely nickel, pretty much any of the critical minerals, platinum, palladium, silver, so I think, clearly this is one of the reasons why governments around the world are rethinking their approach to economics, really, Fortress America being a prime example. So the Americans are now realizing, hey, price mechanism in of itself may not be perfect for this because, for example, that's allowed, China to sort of overwhelm the America in terms of manufacturing, ultimately to America's, short-term benefit but long-term pain. And now the Americans are realizing this and realizing, hey, now we're in many things like scandium and germanium and the rare earth magnets and critical stuff for their defense infrastructure. They're in deep doo-doo, so now they realize, hey, we can't let that happen. So the Americans, are slow to wake up, but once they wake up, they're very quick to move. So I think we're seeing a changing America, before our eyes in terms of how they're going to, reshape things on the supply line. So I suspect, there will be more investment in mining now than ever before, it's coming at the right time because it's a hell of a time to be looking at investing in mining because we've been on our ass for the last 10 years, and I think the spread between commodities and equities is at its peak right now. So it's a phenomenal time for people to put investments in because they're probably going to do very well, and it's a great time for investors to be considering the space because of the divergence, and eventually things revert to the norm and eventually skate the other way, right? So there will be, you can look at the charts, I'm sure you've seen them and happy to send them if you haven't, but there will be a swing back. And so I think it's ultimately that's the message. The message is there's been an underinvestment for a long period of time. It's an inelastic space. So now they're almost at critical danger levels for national economies. So now there's going to have to be a total government response and a market response to get investment in the sector where it's so desperately needed.
No cycle or no moment in a cycle is ever quite the same. And I would say for 2025 anyways, I think what we're seeing is, number one, a lot of choppiness, a lot of volatility, a lot of noise, but also combined with a strong desire for miners to deploy capital and to continue progressing projects. So we're far from being in a market environment, at least today or thus far this year, where we've seen mining companies just pause everything. And those two dynamics are perfect for us as Ecora and as a royalty financier. They create circumstances where our product is, by virtue of it being very flexible, by virtue of it being an alternative to and an incremental to other sources of financing, in high demand. So we're seeing a lot of opportunity at the moment. It's always hard to predict when that opportunity or if that opportunity might translate to transactions and acquisitions. A lot needs to align, and we've spoken about this before, Scott. As Ecora, we're not often the only solution in a financing structure. Oftentimes there's a debt piece, there can be an equity piece, there can be other forms of financing, and we can be one piece of the wider puzzle. But today it seems the most available relative to debt and equity. Debt is generally more available, and equities can be more scarce. But in many ways, that's positive for a royalty company like Ecora because our product naturally can replace a portion of equity from capital structures.
I think they are. I think everything, once again comes down to implementation. I think we've seen some implementation already with the expedited permitting that we just went through. I think that the continued push from not only the executive but down into the actual agencies, I think will be very important. And we've had really positive meetings around, the desire to, follow those executive orders and get things done. So this has probably been, and I've been, involved with Anfield. We started Anfield back in 2013. This is the first time we felt like a real push and real support from the government side, because they're looking to achieve, energy independence. And certainly, the only way to achieve energy independence is to support, local businesses, support domestic businesses. And I think from that perspective, we've seen a great deal of support, and we'd expect to see it going forward.
Yeah, we have seen curtailments. The part that I think I maybe missed earlier in the year when we last spoke is that you've had projects that are bringing tons into the system, maybe through the end of 2026, that were built, towards the peak of November 2022. So it's been pretty stubborn. We've had some green shoots of some stress in some projects in Zimbabwe where they've asked for royalty relief, export rebates, other things, other concessions that you'd only ask for when your project's struggling. CATL at one point closed a lepidolite mine. That's very low grade ore, generates a lot of pretty brutal waste products, but they have a decent reserve life. So we've seen some of these projects kind of come in and out. Right now, they're continuing to produce, but like I said, I think we're one project away from care and maintenance where we're back on the front foot, so to speak. So we are oversupplied, and every sell side firm, it seems every week or two, comes out with a new, more bearish forecast of forever deficits. But given the growth rates we're seeing in not just EV/ESS, but the other category, it's not going to take long to reduce these inventories and get back into a bull market.
Yeah, I mean, polymetallic mines are just like any mine in that ultimately what it comes down to is, the grade of the rock and the value of the metal that you can recover from the rock versus your cost of extraction. So margins, just like any business, what's the margin? So in polymetallics, especially high grade polymetallics like we've got it in the at Power Metallic, the margins are phenomenal, right? Or will be potentially phenomenal when they get in production, because we're looking at plus $500 rock theoretically, and your cost might be $50, $60, $70 depending on your size and stuff like that. So tremendous margins. When you look at 1 gram gold is considered a good rock. That's I don't know, somewhere like 120 or something like dollar rock. So 120 versus 500, it's like all that excess is margin, so that's what makes these things the most exciting mines in the world, and the ones that the one we're focused on is a particular type of polymetallic called orthomagmatic, and there's only like about 20 of them in the history of the world, and they're all either majors like 1 million contained tons of metal or super major more than 10 million tons, so they're big, so they're highly valuable in terms of grade and recoveries and revenue, gross revenue and gross margin, and large. So that's if you can find those things, obviously they're fantastic, and that's we've been blessed, been able to sort of discover one, and now we're obviously proving it out and trying to get it to a production decision as quickly as possible.
And the final segment, we're going to touch on company-specific catalysts. Each of the companies will outline key topics related to what they're working on and the key catalysts ahead over the next 12 months.
Yeah, it was interesting. Obviously, it started off as a nickel sulfide project. So we had a nice nickel sulfide resource. We had bought it 3.1 million tons, about 1.5% nickel equivalent. Grew it to a little over 7. It's probably around 8.5 or so now. But in looking for more nickel sulfide, we had stepped out 5.5 kilometers away and looking for another nickel sulfide zone. There's a humorous story about that, but probably don't have time to get into it. But we basically struck what we were thinking was going to be nickel, and we hit this massive copper sulfide zone, which was totally unexpected. We did it for the right scientific reasons, but we got lucky. Thank you God. It was just one of those great things. And then I remember when we getting the assays in and saying, "Hey, better check these assays again, because there's no way I'm going out with those unless they've been checked twice." And they sent back, in the same text, "Already done." And I was like, "Wow, what a great moment that was!" Because we're Hanam Partners in London, a very fine investment bank, says said in January we had 10 million tons of almost 7% copper equivalent. That's ridiculous numbers, right? There's nothing like it on the planet. And these types of discoveries, it turns out it became an orthomagmatic. And so the orthomagmatic discoveries are very rare. And they're basically nickel sulfide systems, but a different form. So they're zoned to go from nickel ultimately to copper. And so that's what happened in our system. That's why we brought Dr. Steve Beresford in, who's like the top expert in these orthomagmatic systems, and been able to sort of use a lot of his techniques to really expand our discovery pace and understanding. And so we've got obviously high grade copper, high grade platinum, palladium. I mean, that's the other sort of thing that people have, I think, fallen asleep on a bit on Power Metallic, is that we're probably the second best platinum palladium discovery in the planet. And as platinum palladium kick out and start to look like they're going north, our copper equivalent numbers are going to go way up just because we're so cranked with PGEs. So there's that. So I would expect that we'll go from strength to strength here. We'll get more resource discovery at the line zone. We'll also believe find other line zones, and then ultimately we think underneath this thing there's going to be a very rich high-grade nickel sulfide system, a traditional, which we'd expect maybe based upon the math, probably north of 2% nickel, north of 2% copper, but massive. Think of Voisey's Bay, another orthomagmatic discovery. When it was sold for $4.5 billion, was 47 million tons at the time. Yeah, and it's now like over 140. So this thing could get big, and I've been cautioning people to look at it that way, and we certainly talk about it. There's a great triangle piece in our presentation that's online at powermetallic.com, and in this triangle we sort of have PGEs or noble metals at the top, nickel at the one corner, copper at the other, and in these orthomagmatic systems there's somewhere always sort of in between there, and we're Oktябrьский, which is Norilsk, is sort of right in the middle. It's the world's greatest mine, the only mine in the history of the world with $1 trillion worth of material, $1.4 trillion, 90% of it in 1 square kilometer. I mean, think of that square kilometer, it's just ridiculous. So we've got grade like Norilsk, but just not over a full depth of a square kilometer. Ours is about 15, 20 meters, but hopefully over a few more kilometers. But the interesting observation is that all those orthomagmatics, generally for every ton of copper, you'll find 5 tons of nickel. Right now at Lion and NISC, at the NISC project, the whole project, we're probably at 1.2, 1.5 tons of copper for 1 of nickel. Soon to go to 2 tons of copper for 1 of nickel. What does that mean? Well, it means we're finding copper, which is great, but also means there's probably amazing upside potential to find a lot more nickel, like high grade nickel, and the people should not lose sleep on nickel. Nickel is, even today, at its low price range, 15,700, 16,000 a ton. Copper's not even 10,000. So you'd rather find copper high grade, nickel high grade than high grade copper in a way, because it's more valuable. So people think nickel's a bad word, but it's not. And especially in a system like this, where you've got, probably we'll have our revenue 33% from copper, 33% from nickel, and 33% from the noble metals, platinum, palladium, gold, silver, almost equal parts. So these things will be lucrative and big. So it's exciting times to be at working in the Lion Zone, and you'll see lots of exciting news coming in the next few weeks that'll I think re-energize the stock. So for us at this stage, it's all about finding more resource. So as we continue to roll out better assays and more assays, and because obviously we're scaled up, so we'll do 100,000 meters between now and the end of 2026. So that's a lot of drilling. So I think we got here at maybe we're at 25,000 meters all in, and we're at call it somewhere between analysts are saying between 10 and 20 million tons, whatever. Somebody pick a number, but we're comfortable with those numbers. We think we'll eventually exceed them all. So can we quadruple that by the end of that period of time? I would think so, because we're working with some pretty great technology that's been very highly effective. So the catalyst for us, I think, will be more positive resource assay announcements. I would think that highly likely that we'll add more land in the immediate area, since we see a bit of a burgeoning area play that that potentially could grow with it. So that would make sense for us. And I think that we'll continue to surprise people with how quickly we can grow and how big this is going to be. So I would think watch for the assay announcements, watch for the land growth opportunities that we're exploiting, and then at some point look very seriously at getting involved in the power metallic ride. We've had a pullback in our share price, which is not unusual in these scenarios. I was listening to Rick Roll the other day, and he was saying his three biggest wins, which were like 100 to 1,000 Xers, all had three different retrenchments of 50%. And so this happens, and nothing goes straight to the moon. You'll always have these pullbacks, and on the pullbacks, the nervous nouse will be like, oh, I better get out because it's over. And then the real investors look at the real data, look at the real science, and say, wow, they've got 50 million in the bank or thereabouts. They've got some amazing resource. They're not coming to the market anytime soon. They're doing all the right things. They got the best minds in the world working on it. That's a buying opportunity, my friend. You buy the dip. So I think that's where we're at right now in power metallic. So anyway, that's what we're telling investors, and that's what we believe ourselves.
Sure. So, we did receive expedited permitting approval for Velvet Wood, which I think is very important for us. We went through a process with Department of Interior through BLM, whereby we were in a process with BLM for 12 months prior to participating in this process. I think from our perspective, having the ability to look at one of our best assets within the portfolio, past producing mine, underground mine, low environmental impact, small environmental footprint. I think those are some very important projects to have put through the process. I think from that perspective, we do have other projects within the pipeline. Slick Rock is one that will be coming up as part of our production pipeline, and others within Colorado, the West Slope properties, et cetera. So I think that this opens up the door for us to continue to move those assets forward in an expedited manner and responsibly. I think that our ability to do that is going to be shared, and that interest in making success of those projects is going to be shared by the government. So I think having the government on side when it comes to moving these assets forward is very important to us, and I think that it's a massive opportunity for us as a company being recognized by the government, having our business facilitated by the government, whether it's funding, permitting, other avenues to move forward. I think is very, very important, and I think it's important that from a government perspective, having the win of a company like ours achieve production in the relative near term, it's another way for them to kind of wave the flag and say, look, we've promoted, we've agreed to, we promised to make energy independence a key, factor of our plan moving forward. And certainly Anfield, we can hold Anfield up as one of those projects that, has achieved what we've set out to achieve here. So I think we're in many ways, reflective of what the government's desire really is. So I think that the government, is its best interest to make sure that we are successful. Well, look, I think we're going to be moving forward on Velvet Woods, getting local approval, state approval for the asset, and then ultimately look at construction of the mill, which we're looking at late 2025, early 2026, to get that prepared for production. Velvet Wood, we're about to submit our plan of operations once again to BLM, and hopefully we'll be, joining Anfield in the expedited permitting process on the relative near term. We have other projects within the portfolio, as I mentioned. We've got 21 DOE leases in Colorado, many of which are past producing mines, and on, once again, federal land. So they're certainly candidates for the expedited process once again. So if we're able to move those ones forward too, that certainly, creates a bigger pipeline from which we can exploit production. As I mentioned, we're looking at 3 million pounds per year of production capacity at the mill, so there's an opportunity to increase production capacity. So there's certainly some catalysts on the mining side. I think from an investor side, we still have the NASDAQ permit in place, so the NASDAQ application in place. We've submitted the application to NASDAQ. We've got the SEC review taking place right now, and we expect to be trading on the NASDAQ, in the summer. And so that's going to be a massive catalyst for us going forward, because we'll have, a larger pool of investors potentially, invest in Anfield. So I think we've got a couple of things near term that will be valuable to us, and certainly helpful to the company, and certainly open up doors to more investors who want to participate in the upside of our uranium story.
Yeah, I think we see it at Ecora through somewhat nuanced perspective. And as a royalty company, we're somewhat differentiated in that many of the commodities that we target with our critical mineral strategy may not be those targeted by other royalty companies. I think copper is a commodity that lends well across the precious or the critical mineral space. But as you move down the list of critical minerals, we tend to find less and less competition. And I think the royalty model has been more successful more generally, because royalty financing is a form of capital that's generally available throughout commodity price cycles, somewhat independent, although not entirely, of course, to cyclical price levels and the availability, for example, of equity. And in a world where you've seen less equity capital available, the constant availability of capital from private sources, the royalty sector, has really helped push a lot of projects along the development curve, if not into production. The product itself is actually quite flexible, but the bottom line, why are royalties interesting, or royalty and streaming? If done correctly, these can be a really accretive form of financing relative to other forms of financing to the mining sector. And that in and of itself, I think, the ability to drive cost of capital arbitrage, improve return on invested capital metrics, that's sort of I think the question and the product sort of speaks for itself and answers the utility in terms of what it can accomplish by virtue of that alone. For Ecora, I think it's free cash flow. And I think 2025 is a very exciting year for Ecora, and its Ecora shareholders, because we've built a portfolio that 2025 will begin demonstrating the portfolio's free cash flow generation potential. I think a lot of our base metals assets, in other words, our non-kestrel royalty assets, where we've built our NAV exposure to around 80% of our NAV exposure are base metals currently, although that's underrepresented in our revenue. And I think starting in 2025, we're expecting to see a sizable ramp up in the contribution from base metals, other critical minerals, from investments we've made in the past, but have not yet demonstrated the true free cash flow potential of those assets. And those are the only ones that are in productions. Over the next 5 years, I think what I'm personally really excited about is to see assets that have not yet come into production, but are expected to come into production over that horizon, start to generate free cash flows and demonstrate in a really tangible sense what is the true free cash flow generation capability of the portfolio we have at Ecora.
Well, I think that there are two types of catalysts to keep an eye on. We have internal catalysts. For us, consistency of operational results is key. Producing what we planned to produce and controlling our cost. It may not sound too sexy or exciting, but that's the secret sauce from which Amerigo generates consistent free cash flow that is being returned to the shareholders. So just doing what we say we're going to do is a very powerful catalyst. Another important catalyst to keep an eye on for Amerigo specifically is reaching debt-free status at the end of this year. That will further boost our already strong free cash flow generation capacity even further. Well, I would speak more than a performance dividend, just a general dividend, because we have the quarterly dividend and the performance dividend. So just in terms of our capital return strategy, or CRS, at the beginning, when we started this in 2021, we had two very distinct teams, team dividend and team buybacks. Over time, the tendencies have softened because we have demonstrated that we can have both. And during the first years, I think it was the first 2 years of our CRS, we were doing 50% buybacks, 50% dividends, and right now, as of today, we're around 60% of the capital has been returned as dividends and 33% as buybacks. So we've been active on both. Institutional investors tend to prefer buybacks because they clearly see it makes sense from an allocation perspective to do these purchases, and also they do not trigger taxes. But for other investors, cash is king, and they love their quarterly dividends checks, which are paid like clockwork on the 20th of each quarter and month. And of course, the performance dividend check has been very, very well received, Scott.
Yeah, we have 35 royalties. I'd say 70% of them are sort of assigned as zero value by the market just because the pricing dynamic's been so difficult. So those are kind of gonna come back into focus once prices get back to a more reasonable level. The two big assets for us, as I mentioned, are Mariana and Tres Quebradas. They're going to be producing June and July of this year. Hopefully, we'll start collecting royalty payments towards the end of the year. But the focus for us, as I said, is the ABCs of hard rock: Australia, Brazil, Canada. Canada needs slightly higher prices. Brazil's been doing an unbelievable job. Our sort of key royalty there is Grota do Cirilo, operated by Sigma. We bought that when they were a $108 million company with 13 million tons of reserves. We paid $7 million for it. They're going to do 320,000 tons this year. They're fully funded to their phase 2, which will be 500,000 tons. So even at today's prices, maybe a little bit higher than today's prices, over the next 3 years, they do call it Canadian 400 million of revenue and 60 odd million of EBITDA. The market's got a little bit of balance sheet concerns with them, but they've been phenomenal operators, and those expansions are the gravy for royalty companies because you don't put those in your model. We get to a 15% after-tax return just using phase 1. So when they're able to execute and bring that project up, it's fantastic for us. We have an asset in Northern Territories, Australia, operated by Core Lithium. They've bought out their offtake. They've retooled management. They've taken their mining and processing costs way down. They've bought out their the offtake. So that's an asset they're looking at restarting. They have $30 million of cash. They will need some external capital, but there's $250 million of sunk capital. So if and when prices come back closer to $1,000, that's an asset that's a 2.5% GOR for us that could be north of $3 million US a year, even at today's prices. So things like that can change very quickly, but for the time being, the market's really not going to give it any present value. Yeah, so we made a tough decision to sell the 0.5% of our Tres Quebradas royalty to Triple Flag's Precious Metals. They paid $28 million US for that. It was way above sort of what the market was discounting. It was way above the analyst carrying value. The nice part for us is we maintain a 0.9% interest, but it does bring our cash balance at the end of Q1 to $32 million. Part of that was motivated by the fact that we think we can buy back our shares extremely cheaply. We only have a reasonably small float cap, but we did a $7 million SIB via Dutch auction. We ended up raising the price. We only got 45% uptake at $5.70. And then our buyback bought some residual shares at around $5.35. So, that's $4 million of capital that we've taken to buy back our own shares. And, we think with a 3-year view, we're going to make out like bandits on it. And I think that's, anyone who's read the book, The Outsiders, this is what you're supposed to do when your company and your sector is out of favor. So we have 2 big brines coming in this year. We have a Sigma phase 2 expansion. There's some optionality around Finis restarting. Rio Tinto operates 5% of our portfolio, so we'll learn more about their plans for Quebec and Mount Cattlin, which is one of our first royalties that we've ever bought, and we're on our 4th owner. So it shows you the value these royalties can persevere through different cycles and different owners. So there's a big percentage of our portfolio that's not working today, but that's a function of price, and ultimately that's gonna come full circle for us.
Look, at our stage of the development, we're obviously entering that final definitive feasibility commitment in front of financing investment decision on a very large scale coastal project in Chile. And, at the moment, specifically with Hot Chili, we're entering this very exciting phase where we have really three key areas of our business: the development of Costa Fuego front and center, the development of a business development opportunity in Huasco Water and the associated opportunity for a regional water business for the Huasco Valley. But most importantly, what we're very excited in is our new discovery, La Verde, which is adding further shape to Costa Fuego, and we're looking to integrate a large front-end open pit source to increase further the mine life on this 20-year project towards 30. So that for us represents a key catalyst getting underway with our phase 2 program, starting to see how big this discovery can be and what the impact will likely be on our larger development. But I guess more so right now, what the company is doing and what we've been very clear is we're in that exciting phase of a lot of discussions on potential partnering to advance Costa Fuego into financing and then into construction. So, look, I imagine those partnering discussions will play out over the coming months. They've been well advanced for quite some time, and Hot Chili has been lead up to those discussions for over a year now. And the culmination of our pre-feasibilities on our copper and our water project has facilitated those discussions now advancing towards a more granular outcome. So I imagine that will be key for our investors, understanding how the company is going to be financing this final stage. That in itself will likely be a catalyst because the company is focusing, of course, its efforts on asset level investment opportunity, and therefore value metrics that are multiples of our market cap. So, look, we'll be very careful to take our time with those discussions and bring the right partner in to the project that will be able to assist the company in financing and no doubt add a lot of credibility and capability to our development story in Costa Fuego. Look, I think water is going to be one of those natural resources that we've always understood was critical for mankind. I think that's going to grow in the future. Probably not to the level in our lifetime, Scott, where we have to worry too much about it. But when you're in the driest desert in the world, in the Atacama, where 25 or 30% of the world's copper comes from, and probably more if you go further up into Peru, water is existential for new mines to be built and for existing mines to continue to operate. The regulatory changes in Chile are probably going to be followed by Argentina and into Peru. So water conservation of continental water is going to be key to how the mining industry builds new mines. And so therefore desalination water networks are absolutely key. And so I think water is going to be critical to new copper supply because that is a critical element of where most of the world's copper supply comes from. So without water, there is no copper. Without the copper, there also is no water businesses. So developing Huasco Water, we certainly are developing a very intimate understanding of the relationship between water and copper. And it's going to be key over the coming decades as to how the world solves this impasse to bring undeveloped projects to the table into production to meet new demand.